A home equity reverse mortgage, or a HECM, is a Federal Housing Authority insured reverse mortgage issued by the Department of Housing and Urban Development through approved lenders nationwide. It is intended for borrowers who are aged 62 years and older, and its unique features make the HECM a valuable tool in retirement planning and aging in place, and especially for helping people pay for unexpected long-term care costs. So how does a HECM help with long-term care? It helps in three general ways. It can aid in planning. It can build up a financial reserve for future years and possibly hedge the value of the real estate that you live in, so that at the time you have to sell it and fund a nursing home liability, you don't run into a situation similar to the years between 2007 and 2010, when values plummeted right at that moment that you wanted to sell. You can also use a HECM to purchase a suitable age-in-place home and avail of the option not to make all or any of the monthly payments, but get a home that meets your needs and permits long-term care. Or you can use your current equity to help fund emergency or ongoing medical expenses. Before we start discussing how a HECM can help you, we best discuss what it is. Well, it's a loan. It is debt, and you do have to pay it back. And like any other homeowner, you have to pay taxes and insurance. No, you do not sell your home to the lender. And yes, you can make a mortgage repayment if you wish to, but you have the option of not having to. You will never owe more than the value of your home, and if there's any equity in that home, it's always yours. You can leave it to your heirs. So how is a HECM different than a conventional reverse mortgage? Well, under the program, but only for the purpose of calculating the gross loan amount, the maximum value we will consider is $636,150. Another feature is that if the line of credit under the HECM is unused, it will grow annually at the rate of interest and mortgage insurance rate. The loan is non-recourse. You will never be liable for any deficits. No deficits, none. If the house is worth zero, there would still be no deficits. You would owe nothing extra. Non-borrowing spouses are now protected. In the event that the borrowing spouse leaves the home or passes away, the non-borrowing spouse can never be asked to leave the home until they themselves leave or die. Additionally, the funding is guaranteed by the U.S. government, and this is important if you're going to live a long time. If you think that you're going to stay in your current home and use a HECM over the next 30 years, it's not a bad idea to have it guaranteed by the U.S. government. FHA lenders are also required to help with any tax and insurance defaults if it's temporary. Loan services are directed to advance funds to help pay these delinquent taxes and insurance. They expect, of course, to be repaid, and the repayment period can be anywhere from 12 months to 36 months. But in the event they don't get repaid, or you keep having annual tax insurance defaults, it's very likely that they will proceed in a foreclosure against you. Let's take a look at a few examples. In this example, Mary, a widower, had a pension, Social Security, and some savings, but she had recently learned that the average older person can pay as much as $250,000 in nursing home care, medical premiums, and deductibles during the course of their remaining life. Mary didn't need the money, but she didn't want to be forced from her home someday either if an emergency arose. She owned her home, which was worth $400,000, with no mortgage. Mary qualified on her $400,000 home appraisal for a HECM line of credit of $203,000. Because the program assumes that Mary would draw the money immediately and never make a payment, they set aside $197,000 of the valuation as a reserve for future unpaid mortgage insurance and interest. Now, if Mary did want the money suddenly and immediately, she would only be allowed to pull out 60% of the $203,000 in the first 12 months. This is a restriction that FHA has recently put on the program to limit risky withdrawals by pensioners who are not aware that using the money too fast will deplete their resources. But if Mary did not use any of the proceeds, The line of credit would grow and increase annually at the interest and the mortgage rate. So what happened to Mary's line of credit if she didn't use it for 5 years? Well, after 5 years, the line of credit had grown to $269,000. This was because $66,000 less interest and mortgage insurance premium reserve was required because she didn't draw any money during those 5 years, and we assumed that she would have drawn all the money at the beginning of the mortgage. Any unused reserve, anything that we don't need, we're going to credit back to her so that she has it in her available line of credit. This process can continue until Mary either uses it or she sells the house. However, one point that is worth mentioning: if Mary were to draw $100,000 on this line of credit, we would start charging her interest and adding it to her balance outstanding. And she doesn't have to pay it to us, but she could if she wanted to. She could pay it back monthly. The remaining $169,000 that she did not use, it would continue to grow as the original $200,000 had grown. We would credit back to her account the interest and the mortgage insurance premium that we had assumed she would be paying on this mortgage as she went through time. So you can see that the HECM growing credit line availability, if unused, is an excellent way to hedge unexpected future medical or other costs or any emergency. By taking out a HECM line of credit, as Mary did in the last example, this borrower figured out that it was possible over time the line of credit was worth more than the home's original value. Now you might say this takes a long time, and who cares? Real estate goes up in value all the time. Well, it does in general, but not always in a straight line. Sometimes, and when you need it, it can go back down. Many things impact real estate values: supply and demand, utilities, rural versus urban, transportation, and the rest. You can't always be certain that real estate will go up. The unique line of credit growth feature means that if unused, the line of credit grows at interest and mortgage insurance premium annually. In this example, even if the home was worth only its original $200,000 and the line of credit had increased to, say, $250,000, the borrower could draw the entire amount and hand the home back to FHA and not suffer the deficit. The upfront mortgage insurance premium of $1,000 paid on this transaction ensure that FHA takes the risk off of your hands and you will not be liable for it. Another example of how a HECM can help you age in place is if it allows you to buy a larger, nicer, more suitable home as you get older and not require that you make a monthly payment. In this example, our borrower owned a $400,000 home he did not much care for. He had no mortgage on it. He sold his current home for $400,000, kept $150,000 out in cash, and invested $250,000 in a new home. He got a HECM for purchase for $350,000, and that, plus his $250,000, allowed him to buy his $600,000 dream home. It is important to understand that a HECM for purchase is not limited in the first 12 months disbursements. You are allowed to use the entire HECM proceeds to buy a new home. There is a higher upfront mortgage insurance premium, and it is considerable. But in this transaction, the borrower considered it just to be an additional purchase price on his home and worth it because of the optional payment plan feature of a HECM. There are limitations on the ability to use a HECM that you should know about. Some have to do with the amount of money available in the first 12 months, but the one I want to discuss here is the due and payable event that can arise in certain circumstances. To avail of the HECM features and not have it called due and payable to the lender, the borrowers need to avoid a maturity event. A maturity event occurs when all borrowers have passed away. In this circumstances, the house would likely be sold or bequeathed. All borrowers have sold or conveyed title of the property to a third party. The lender will definitely want to have his money repaid to him in this circumstance. The property is no longer the principal residence of at least one borrower. The borrower does not maintain the property as a principal residence for a period exceeding 12 months because of physical or mental illness. If all the borrowers are in a nursing home for over a year, you may be required to pay the money back. If the borrower fails to pay property tax or insurance and all attempts to rectify the situation have been exhausted, the lender will go to HUD and ask them to foreclose. If the property is in disrepair and the borrower has refused or is unable to repair the property, this will likely also cause a maturity event. However, in these circumstances, there's usually a safety element involved. If you want to learn more about reverse mortgages, go to Amazon.com and find the ebook Reverse Mortgages for Retirement. It's got about 130 questions and answers on the most important aspects of reverse mortgages. Or if you like, reach out to me and I'll send you a copy. I also recommend you go to our website, jmcapitalreverse.com. It's loaded with information for both professionals and for consumers. Finally, if you think I can help you, reach out to me at my email or call me on my cell phone. I'd be delighted to answer any questions you have. I hope you have found this video helpful.